Hi everyone. This video was inspired by Marianne, so it's dedicated to her. It is Thursday, 2 days after the U.S. midterms, and as expected, uh, it was a big shakeup in the U.S. and there's been fallout. The markets have reacted as most of us expected they would. And the question I'm getting from people is, what should I do about my money now that the Democrats have taken the House? What's Donald Trump going to do? What's the expectation in the market? And of course, I know it's unsatisfying, but for financial advisors like myself, the answer really is it depends. It depends on a number of things, and we'll get into that. But what I wanted to focus on, of course, is that the market itself is a reactive organism, and it goes up and down. And when I say that, the ups are usually a lot bigger and longer than the downs are, and the downs are really never as bad as it seems, and except for the situation where you actually need that money today. If you're coming into retirement, if you're investing to make a large purchase like a home. What I've got up on the board here is just a bit of a version of an index chart, which is a simplified version of one of these. If you'd like to get an updated version of an index chart, send me an email and I'll get you a copy of that. But what it does is it summarizes all of the market ups and downs over a period of time. And what we're looking at here is what the investment markets have done since 1980, so 35 years worth of activity. The green obviously represents the times when the market has gone up, and then the red are the times when it's gone down. Since 1980 to 2015, there have been four major downturns in the market, for those of you that are old enough watching this to remember. In 1980, early in the 80s, there was a large downturn in the marketplace. Keep keep it in perspective, mortgage rates were about 21% at that point. So we're doing pretty well right now. But then it came back again, and then towards the end of the 1990s, there was a major market crash that we called Black Monday, and there was a lot of wealth that was wiped out, but only if people sold out. So coming back from that through the 90s was a relatively stable period of long, what they call a bull market, charging forward, little dips up and down. And then at the beginning of 2000s, we had three major events that caused the market to take a real tumble. There was the 9/11 attacks. There was the Enron. So finding out that a number of large organizations had um, fraudulent financial statements, and a number of companies collapsed, as well as Nortel, which was Canada's big telecommunications firm that was a major part of a lot of everyone's investments, also started to lose value. And then it came back again mid 2000s and was doing quite well up until 2008, when the last financial crisis happened, right at the end of the George Bush presidency, and then it came back in through 2015. So it's a pattern that repeats itself over and over again. And if you look over any 10-year period or any 20-year period from 1990 to 2000, just between those points, the money's up. Between 95 and 2005, the difference between where your investments would be is much higher. The real danger for people happens if your time frame is short. If you needed money in here, or if you needed money in here, you were not in a comfortable position. So that's why I say if you're only looking for a few years or a few months, being exposed to market volatility is not a good thing, because we never know when these things are going to happen. So I hope that gives some perspective. So what are really the issues that you need to think about when you're looking at an investment? Well, the most important thing to think about is time. How much time do I have before I need this money? That is, do I need it to fund a purchase soon? Do I need it to generate income at a later date? And when I do take that money out, am I going to take it all in one lump sum, or am I going to draw against it over a period of time? Because if the time, as I'm sure you've now figured out, if it's short, you don't want to be exposed to any of this. If it's a long term, if you're in your 30s and we're talking about retirement money, you can absolutely put money in and handle a few of these downturns. They're not fun, and you should work with an advisor that can remind you of these conditions and let you know that when the markets go down, it's not necessarily a bad thing. Just as a bit of a segue or a sidebar, uh, these downturn here, those are great opportunities for people who had access to cash and they could buy investments that were more or less on sale. And when they came back again, their investments were much higher. So people who sit with cash out of nerves because they're afraid to get into the market because they don't know what's going to happen, these are great buying opportunities. So time is the first thing. How much time do you have for your investment to start to gain and recover when the market goes down? Because it always does. There's no safe period. There's no safe investment. The second is allocation. And working with clients, trying to understand what's the best allocation for their investment, and that is what spectrum of investments makes the most sense for them. How much of it can be in Canada? How much of it can be international? How much of it should be in financials like banks? How much of it should be in healthcare? How much of it in IT? How much of it in natural resources? How much of it should be in bonds? So understanding that allocation so that when these things go up and down, and of course, if you go deeper and deeper into these numbers, there are some things which actually did quite well in those red periods, and how much of that should be in your portfolio. So that allocation, and that makes the biggest difference in your long-term returns after time does. The next is currency. So currency is a little tricky, and it's not really something that investors have to worry about necessarily because fund managers tend to price currency issues into their investments. But what that really means is if I'm investing with Canadian money and it's purchasing investments that are in the United States, in Europe, in South America, in Asia, what's going to happen when our currency is competing with theirs, when theirs goes down and ours goes up? How does that affect my overall investment? So making sure that you're adjusting for those currency differences, which are beyond your control, but you need to anticipate. And finally, the fourth one is diversification. And when I mean diversification there, I don't mean necessarily within your portfolio of your investment, but your diversification across all of your financial assets, real estate, um, investing within the different tools that have tax structures that may be beneficial to you. Is your RSP maxed out, or should it be? Is your tax-free savings account maxed out, or should it be? Is non-registered? How does it affect your taxes when you're looking to draw that money out later? And then what type of insurance do you have? Are you diversified enough so that if you die too soon or become sick or injured, are we protecting these assets here from cannibalization? Does permanent insurance and the tax structures that are within that, do they make sense inside your portfolio? Um, so those four things are the things to think about if you're sitting down with an advisor um, when you look at that. So if anybody is losing sleep right now because of the U.S. political situation, uh, give me a call. I'd be happy to sit down and talk about it. If you'd like to have a copy of um, the more recent index chart that has more details on this, send me an email and I'll make sure that you get a copy of that. Any questions, please submit them below or send me an email and I'm happy to answer them. Thanks for watching and I hope this has been helpful.